Welcome to the new video of Freedom Blueprint. In this video, we will talk about daily bias using external range liquidity and internal range liquidity. Internal range liquidity is just a fair value gap. If you don't know what is fair value gap, the gap between first candle wick and the third candle wick is called fair value gap or imbalance. You can see in the diagram first candle wick and the third candle wick. The gap between these two candles is just fair value gap or an imbalance. What is external range liquidity? External range liquidity is just highs and lows. Defining internal and external range liquidity. Internal range liquidity is defined by fair value gaps and external range liquidity is defined by highs or lows. When external range liquidity is taken, a fair value gap becomes the next draw. And when the internal range liquidity is taken, then a high or low becomes the next draw. Market does only these two things: fill the imbalance and seek liquidity. Let's took out this external range liquidity, and now we are looking for that market will take this fair value gap, that is internal range liquidity. Market took out this internal range liquidity, and now our next target is external range liquidity, that is this low. Market took this low also. It is the relation between internal range liquidity and external range liquidity. Daily bias is one of the most important concepts in trading. If you're doing trading without the context of higher time frame, then you cannot make money in long run. After watching this video, don't forget to backtest it on your charts. Let's have some real chart example for the better understanding of this concept. This will be 3 video series of daily bias. In this video, I will just talk about internal range liquidity and external range liquidity. I will go in detail in coming lectures, but for now, I think it is enough. Market took out this external range liquidity. Now our next draw this internal range liquidity. You can see here, we also have internal range liquidity here, but it is not in discount zone. If you have not watched the first video, then go and watch that, premium and discount zone. We are looking for the fair value gap in discount zone, and here we have. So this is our internal range liquidity. We are expecting that market will take this internal range liquidity and then we'll look for external range liquidity. Market took this internal range liquidity, and now what we are looking for? We are looking for this external range liquidity, that is this high. Market took that external range liquidity as we expected. Now what is our next aim? Our next aim is this internal range liquidity, that is fair value gap between first candle wick and the third candle wick. Market took out this internal range liquidity, and now we are expecting that market will take out this high, that is external range liquidity. Market took out the external range liquidity. Now again, the same process, we are aiming for this internal range liquidity, the gap between first candle wick and the third candle wick. After taking this fair value gap, this internal range liquidity, what we are looking for? This external range liquidity, this high. Okay, market took out this external range liquidity also. Let's have one more chart example for the better understanding. Market took this external range liquidity. Now what we are looking for? We are looking for this internal range liquidity to be taken out soon. This gap between first candle wick and the third candle wick. This is fair value gap, or you can say imbalance. Market took out this internal range liquidity. Market can fill this gap half or full, or can touch this and reverse. Our next aim is this external range liquidity, this low. Market took out this external range liquidity as we expected. How to take an entry? There are different ways to take entry, but I will not go in detail in this video. However, I will give you an idea how you can enter the trade. We will use this piece of price action for entering the trade. We look for short entries toward this external range liquidity. This is an intraday chart. As I told you in my previous video that I use 1 hour as my intraday chart. Let's tap on the internal range liquidity, and what we are looking for? We are looking for high resistance liquidity run. Market give us a high resistance liquidity run, and then we have a change in state of delivery. After that, we can enter on any fair value gap we have. Here we have a fair value gap. We can enter here, stop above this high, and the target is external range liquidity. If you miss this entry, there are more ways to enter the trade. Normally, I use this way to enter the trade. It is high probability and has high win rate. Price made a range, and now we are expecting that price will go into premium and tap any bearish order block. We are looking for short here, top above the order block, and the target is external range liquidity. Normally, I use this pattern to enter the trade. This has high win rate, but in some cases, we miss the move and hit the external range liquidity. Let's continue the previous chart example. Price took out this external range liquidity, and now price creates internal range liquidity here. The gap between first candle and the third candle, we are expecting that price will take out this internal range liquidity very soon. And we can see price has taken out this internal range liquidity. Now our next aim will be this external range liquidity. Took out this external range liquidity as we expected. Let me show you this on a bar replay chart. First of all, we draw our dealing range. We can use this as a high and this is as a low. Right now price is in premium zone and hitting this internal range liquidity. From this internal range liquidity, we are expecting that price will go toward this external range liquidity. This external range liquidity will be our target. And now let's see in one hour chart how we can enter here in a short position toward this external range liquidity. This all liquidity has been taken out, so we can say that this is high resistance liquidity run. Here we have a market structure shift here. Now where we can enter in the position. We can enter at this fair value gap. If price tap here, so we can look for short. Price tap on our fair value gap, so we can enter in a short position. Our target will be this external range liquidity, and we can put our stop loss above this range high. If you miss this entry, there are more ways to enter the trade. We simply pick a low and a high and draw the range. We are expecting that price will not break this range, so this is our range high. If price came into premium, we look for short again. We can look for short at this fair value gap. Stop we can set at the range high, and target is same, the external range liquidity, that is in daily chart. You can see how exactly price moved from our internal range liquidity to external range liquidity. This was the relation between external range liquidity and internal range liquidity. Once price took out this external range liquidity, we will be looking for internal range liquidity. After taking this internal range liquidity, we will target this external range liquidity. If you want to see me applying these concepts in the real market before the move happen, you can join our free Telegram channel. The link is in the description.